The word recession has been floating around again in 2025. And if you spend any time in financial media, on YouTube, or scrolling headlines, you've probably seen the warnings. Slowdowns in job growth, consumer spending tightening, companies cutting costs, it's all starting to sound familiar. But then you look at the housing market, and it feels like it's living in its own reality. While stocks are bouncing all over the place, tech companies are laying people off again, and inflation still isn't completely cooled, home prices are holding steady. And in some places, they're still going up. So what gives? Is housing just immune to economic slowdowns now, or is something else going on here? Let's break it down because there's a lot of moving parts. First off, the housing market doesn't react to recessions the way most people expect. It's not always the immediate collapse or crash the moment the economy slows down. In fact, if you go back and look at previous recessions, including the one in 2020, housing actually held up fairly well. The only exception in recent history was 2008, but that wasn't just a recession. This was a housing crisis caused by housing. It was bad lending, subprime mortgages, and a ton of overbuilding. And that's not what we're dealing with today. The current housing market is underbuilt, undersupplied, and still has more demand than it knows what to do with, even with interest rates at or near 7%. And that's a key reason why prices haven't dropped in a meaningful way in most areas. Right now, one of the biggest forces propping up prices isn't buyer demand, it's low inventory. We're still facing a housing shortage nationally. The National Association of Realtors estimates we're short by about 4 to 5 million housing units. That's not a small gap, and it's not something that gets solved quickly. Builders are struggling with high construction costs, labor shortages, and zoning regulations. And when they do build, they're often focusing on higher end homes where margins are better. That means entry level or affordable homes, the ones most first time buyers need, remain in short supply. Then you have existing homeowners. Most of them are sitting on mortgage rates under 4% and many even under 3%. So why would they trade that for a new home with a 7% rate unless they absolutely had to? They're not. They're staying put, and that creates what's often called the lock-in effect. It's freezing up inventory and keeping the resale market extremely tight. And when supply is low, even in a shaky economy, prices just don't have a lot of room to fall. You might see softening, you might see price reductions on listings that were overpriced to begin with, but you're probably not going to see a broad crash unless something massive shifts. That higher rate environment has cooled buyer demand, sure, but it hasn't eliminated it. There's still a lot of buyers out there who need homes. They're relocating, expanding their families, retiring, downsizing, whatever the case may be. Housing isn't just a financial decision, it's a lifestyle one. And that's why you still see competition for well priced homes, even in a so called slow market. Let's talk about interest rates real quick, because that's another part of this story. Right now, the average 30-year fixed rate is floating between 6.75% to 7.25%, depending on the day. And while that's lower than the peaks we saw last year, it's still a far cry from the 3% era. According to Wells Fargo, rates are expected to remain elevated through at least the end of 2025, with only mild easing in 2026. And here's the real twist. When other parts of the economy become more uncertain, like when the stock market gets rocky or job growth slows down, people often shift to focus towards more tangible assets. Real estate becomes one of the things that people trust. It's something they can live in, rent out, or hold long term. Now, that doesn't mean there aren't risks. If we do enter a formal recession, buyer sentiment could shift. We could see layoffs that reduce the number of people qualifying for loans, consumer confidence could take a hit. All of that can impact buyer demand. But again, supply is still the anchor here, so unless we see a massive increase in inventory, prices may flatten, but they're unlikely to have a massive crash. In fact, in times of moderate economic uncertainty, housing has often been seen as a safer hedge compared to equities or volatile investments. So even though rates are high and prices feel steep, some buyers view real estate as a way to create long-term stability, especially if they're planning on staying in a home for 5 to 10 years. What does that mean if you're thinking of buying? It means trying to time the market perfectly probably isn't a winning strategy. Waiting for a big crash that never comes could mean watching prices continue to rise slowly and possibly getting priced out later. So, is the housing market really immune to recession? Not exactly, but it is insulated by some pretty strong fundamentals, mainly low inventory, locked in sellers, and a base level of demand that isn't going away. And if you're thinking of selling, don't assume buyers have vanished. The right home at the right price, especially if it's move-in ready and marketed properly, will still get attention. The key is understanding the conditions and positioning your property accordingly. This isn't a panic market, it's a precision market. And the more you understand the drivers like inventory, rate sensitivity, and local demand, the better positioned you'll be, whether you're buying or selling. If this video helped clarify what's really going on, drop a like and leave a comment below because I'd love to hear your thoughts, especially if you're feeling stuck in this market. And don't forget to subscribe for more Arizona-based housing updates and big picture breakdowns just like this one. Thanks for watching, and I'll see you in the next one.